In India, there are about 4 fund managers who have been managing the same fund for more than 15 years. There is Sailesh Rajbhan, who has been at the helm of Nippon India Multicap. Mahesh Patel has been looking after the Aditya Birla Sun Life Frontline Equity. Chirag Setalvad has been taking care of HDFC Mid-Cap Opportunities, and R. Janaki Raman has been managing Franklin India Prima Fund and Franklin India Smaller Companies. Now, of these 4 fund managers, Chirag is probably the most successful. The HDFC Mid-Cap Opportunities Fund has an assets worth over 59,000 crore. This is far higher than the schemes that the other 3 manage. Now, I don't know about you, but I feel a sense of confidence when I see funds with this kind of track record. Such schemes make the lives of investors rather easy. You can dig into the fund's history to see how the fund manager steered the scheme during different market cycles. It's easier to understand the investing style of the fund manager, his skills and his strengths. And this is what we will do in this video. We will review HDFC Mid-Cap Opportunities Fund. Hello and welcome to ET Money. But before we go into the video, a quick reminder. You are watching this video on ET Money's English channel. हमारा एक हिंदी चैनल भी है जहाँ पे सारी वीडियोस आप हिंदी में देख सकते हैं. And if you are or know somebody who wants to understand the basics of finance in an easy way, we have a channel called as 5-Minute Finance. Do check them out. Now, the track record of the HDFC Mid-Cap Opportunities Fund has been impressive. A monthly SIP of 10,000 in this fund would have turned 12 lakh rupees investment into a corpus of more than 37 lakh in the last 10 years. That's an XIRR of 21.39%. But the fund saw over 66% increase in assets in the last year. And when it comes to mid-cap funds, size does matter. As a scheme grows, the fund manager needs to look for more stock ideas that can give high returns to deploy fresh capital coming in. And finding new ideas keeps getting more challenging as the fund size grows. So how has Setalvad managed the rising inflows in the past 1 year? Let's find out. But before we begin, an important update. This video is part of the fund review playlist. In this playlist, we have analyzed the performance of popular mutual funds. You can check it out if you like this video. The link is in the description. Let's start by looking at the returns. First, we will look at the trailing returns and then the rolling returns. Now, the fund has performed better than its benchmark and category average over the past 3, 5 and 10 years. This is quite an achievement. Most mid-cap funds find it difficult to beat the Nifty 150 mid-cap index. The category average, for example, has been lower than the benchmark in the last 3, 5 and 10 years. Next, we will look at the 7-year rolling returns. That means starting in January 2013, we checked how the fund performed if someone invested for 7 years. So we first look at the data between 1st January 2013 and 1st January 2020. Then between 2nd January 2013 and 2nd January 2020 and so on. This way, we look at more than 1,000 different 7-year returns. Now, as I mentioned before, for most mid-cap funds, it's difficult to beat the Nifty 150 mid-cap index. Only 7 out of 22 schemes managed to outperform the benchmark when we compare their rolling returns. And HDFC Mid-Cap Opportunities Fund was one of them. So this scheme has done better than its benchmark and peers when we look at trailing and rolling returns. But returns are only a half the picture. Let's look at how the fund behaves when the markets fall. After all, a good fund should fall less than the market. To measure the downside protection, we looked at periods when the mid-cap index fell by 5% over any period since 2013 and the fund fared against the index. We found there were 12 such periods. We found that this fund did better in 10 of those 12 periods. This shows that the fund has not only beaten the benchmark but has also managed to contain the downside. Again, this is impressive. But what is leading to this better returns and great downside protection? Well, we will look at the fund's investment strategy to find the answer. But before we go ahead, did you know that unexpected healthcare emergencies can drain your life savings and toss away all your financial goals? So buying adequate health insurance for you and your family should be the first step you must take to achieve financial independence. Now on the ET Money app, you can buy health insurance of even up to 1 crore at affordable rates. So do check it out. Let's analyze how the fund manager has been managing this scheme. For this, we will look at the allocation to large, mid and small caps, how often the fund manager buys and sells stocks, etc. Let's start by examining how this fund has invested across large, mid and small cap companies. Now, as per SEBI's mandate, all mid-cap schemes must invest at least 65% of their assets in mid-cap stocks. The remaining 35% can be allocated to large caps, small caps, and even be held in form of debt or cash. Now, this fund has maintained an exposure between 65 to 70% to mid-cap stocks. The exposure to small caps has varied between 15% and 28%, and large cap allocation has been in the range of 4 to 14%. But how does this compare to the category? Well, compared to the category, historically, the fund manager has maintained a lower allocation to large cap stocks. But there is something interesting that has happened recently. The fund manager has raised the large cap allocation. Now, as of January 2023 and Jan 24, for the first time, the large cap allocation went beyond 10%. Now, there can be different reasons for this. As we discussed earlier, if the inflows increase suddenly, it may be difficult for the fund manager to find new opportunities. This could be one reason why the allocation to large cap has increased. Now, another reason could be the valuation of stocks in the mid and small cap space. The fund manager could be of the view that the valuations are high. There could be a correction. A higher allocation to large caps can help the fund fall less if the markets correct. Next, let's look at how often the fund buys and sells stocks. This tells us the conviction of a fund manager has in its stocks. Now, conventional wisdom says that investors should look for funds that follow buy and hold strategy. The fund manager should not buy and sell stocks too often. For this, we will look at the fund's portfolio turnover ratio. If the fund has a high turnover ratio, it means there is frequent buying and selling. A turnover ratio of 100 means that the fund manager has replaced all stocks in the portfolio. Now, as of January 2024, this scheme has a portfolio turnover ratio of just 19. If we compare this with the highest portfolio turnover ratio, then Quant Midcap Fund has a highest ratio of 342. Now, historically, the fund has maintained a lower turnover ratio than its peers. This means the fund manager has very high conviction in its bets. Now, if the fund follows buy and hold, there must be stocks that the fund manager invested years ago and is still holding them. Well, let's find out if this is true by checking the top 10 bets. Now, 6 out of the top 10 stocks have been in the portfolio since 2018. The other 4 stocks have been in the portfolio for a few years too. This is the reason for better returns and downside protection of the fund. These stocks have generated higher long-term returns. For example, Persistent System has been in the fund's portfolio from 2018 and has generated 960% returns between January 2018 and January 2024. Now, similar is the case with stocks such as Indian Hotels. It has been in the portfolio since 2018 and since then generated a return of 269%. Other holdings such as Apollo Tyres, Max Healthcare, Coforge have generated impressive returns too. Lastly, let's look at the number of stocks the fund has in its portfolio. There are few things you must know about the number of stocks in a fund's portfolio. A lower number of stocks means a concentrated portfolio. If there are lesser number of stocks, then each stock on average will have a higher allocation. So even a small movement in any stock will impact the fund's returns. On the other hand, a higher number of stocks is exactly the opposite of this. The impact of a specific stock's movement will have a little bearing on the performance of the portfolio. Now, this strategy is used by many fund managers to manage the risk of their portfolio, as there is room for errors. Now, for this fund, the number of stocks has been around 70 in the last 5 years. This is higher than the category average. It means that the fund manager takes a diversified approach, and this could also be a factor contributing to the better downside protection that we saw earlier. Now, the number of stocks also depend on the AUM of the fund, especially in the mid and small cap categories. Larger funds typically diversify across stocks. This helps them in various ways. First, the returns from a few stocks doesn't impact the overall fund's performance, but more importantly, it helps to provide liquidity. In mid and small cap space, a large buy or sell order can drastically impact the stock price. By diversifying across a large number of stocks, the fund manager brings down the exposure to a single stock. This way, a fund manager can easily get in and out of a stock. Now, as we mentioned earlier, the fund has grown 66% in the past year. Despite this, Setalvad has not dramatically increased the number of stocks in the portfolio. So what does this all mean? It means the fund manager has not dramatically increased the number of stocks, as this can dilute the performance. He has struck a balance between diversification and performance. It also shows that Setalvad truly believes in his bets. Now, theoretically, not diversifying the portfolio with the growth in AUM can be problematic. In some stocks, it can create liquidity issues. But so far, this has not been the problem for Setalvad. He has stuck to what he thinks is the right approach. Only time will tell how successful is the strategy in the current market cycle. I'm borrowing one crucial observation from Morningstar about this fund. HDFC Mid-Cap Opportunities Fund invests in quality stocks, and the fund can lag behind its competitors during some market phases. The contrarian bets can lead to divergent performance versus the category over shorter periods. However, over a complete market cycle, the fund is well equipped to serve investors well. And with that, we have come to the end of this video. I hope you found this video helpful. And if you did, please share it with your friends and family. I'll see you again with a new video soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.